rest of the world, the U.S. is still going to grow significantly higher. You look at a slowdown in China and the emerging markets. So we continue to see, when I speak to businesses, I still see a tremendous investment dollars coming into the U.S., people investing in the U.S.
All right, that was the Treasury Secretary with Stuart Varney a few minutes ago. Of course, what he leaves out is that if those economies across the globe begin to slow precipitously, and that's a big concern with China, a big concern with Germany, a big concern with Italy, a big concern with France et al., then there's less likelihood they'll be buying from this country or even into this country, and that sort of compounds these fears. The Federal Reserve kind of touched on this possible phenomenon next year as justification for curtailing the planned rate hikes next year, maybe to 2 from 3. Hard to say. Former Federal Reserve Board member of Governors, Randall Kroszner, with us right now. Randall, thanks for taking the time. Maybe you can help me with this. Why do you think the markets were disappointed with what the Fed said in its statement and what Jerome Powell outlined afterwards?
Well, it was a so-called dovish tightening. That is, they raised rates, but they said they're not going to be raising them as rapidly as they have been. But it seems like the markets were a little bit disappointed that they were hoping for a few more doves around this holiday time, and they didn't get as many as they thought they might. I also think some of the
when you say as many doves as they thought they might, in other words, those on the board, the 17 members among them who went from 3 to 2, is that what you mean? That I think it was 11 who did from 9 prior. You were, maybe the markets were expecting more to go along with that sentiment?
I think that's right. I think they were hoping for, rather than moving from a forecast of 3 rate hikes this year to 2, I think they were hoping maybe to go to 1, or I think the biggest precedent of all would have been 0, but I'm not sure that was a reasonable expectation.
Now, you know, I know that the Federal Reserve has to keep its presumed independence. Many had said that this was the Fed chairman's way of saying, I will not be bullied into stopping what I think is the right thing to do, and that might in fact be the case. So what do you think would have happened had the Fed not moved at all yesterday?
I think given where the expectations were that a move was very likely, I think that really would have been problematic because it would have raised questions about the credibility and independence of the Fed. I mean, clearly, Jay Powell has moved twice since the president started his criticism of the Fed, so they are going to do what they think is best, independent of what the president is saying. And I think that's important in the long run for them to maintain their credibility.
You know, Randall, when you were there, how much attention did you pay to the yield curve? And, you know, we're making a big deal now, or at least I am today, because people keep telling me this in phone calls and elsewhere, that it is narrowing dramatically between, let's say, a 2-year and a 10-year note.
Yes.
So close that the 2-year isn't all that far from eclipsing the rate on a 10-year. Now, without getting too in the weeds, and you're very good about avoiding that and speaking English, but every time that has happened, and it hasn't happened a lot, but every time it has, it's presaged a recession. Do you fear that possibility?
Well, it's not quite always. I mean, kind of the joke we had around the Fed is that the inversion of the yield curve would predict 10 of the last 4 recessions. So it happens more frequently than when we have recession. But the key thing is to kind of look behind it. What's driving the difference between the short rate and the long rate? Because normally the long rate is above the short rate. And one of the things that drives that is fears about inflation. So if you expect a lot of inflation, you have to have some compensation for that. And right now, there's not an expectation of a lot of inflation and not a lot of risk of that.
Or it could be the Federal Reserve overdoing it, right?
And that's something that in the past has often happened when the short rate has jumped up really rapidly because the Fed's been behind the inflation curve. Suddenly, inflation builds up. It gets to 2, 3, 4%. The Fed has to zoom up. And I don't think that's the case now because we've seen inflation be relatively quiescent. It's, you know, around its 2% target. So I think it doesn't, that in and of itself doesn't portend the recession. But I do think we have to look at the fundamentals, exactly the issues you were getting back to, you were mentioning before about some global shocks, about other uncertainties.
Randall, when you were there, how much attention did you pay to the stock market? I'm always told we ignore that. It's not in our wheelbarrow. I mean, we can't control that. But you're not oblivious to it, right?
For sure not. We're always looking at, or when I was there, we were always looking at financial conditions, and I'm sure they still are looking at financial conditions. The stock market is one indicator of that. And so they're trying to understand, well, what's driving the tumult in the markets? You know, is it just interest rate increases, or is it some other factors? And I think China is one of those factors. If you look at the exposure of large U.S. firms, like the ones that are in the Dow Jones or the S&P 500, to China, because there's a lot of sales in China, a lot of activity in China. If China slows significantly, that's going to have a big effect on the profitability of those firms, even if the U.S. goes along on a reasonable track.
All right, Randall, thank you very much. But the irony with that, Randall, is that if we do score a trade deal with China and it comes too little too late because China is falling into a slowdown or worse, man, the timing couldn't be worse, you know?
This is tough. I think this is a tough time for investors, but we've got to look at the long run about the